The investment industry has been lying to you, and these lies are the reason most people stay broke while a small percentage get rich. If you believe even one of these lies, you could lose 6 figures over your lifetime, and chances are you believe all 5. The worst part? The investment industry keeps pushing these lies because they make more money when you believe them. By the end of this video, you'll understand why compound interest isn't as powerful as they claim, why you don't need to be a genius to invest, and why everything you've been told about diversification is backwards. Let's destroy these myths one by one. The first lie is that compound interest will make you rich. This is the biggest lie in all of investing, and it's the one that gets repeated most often. Just save $10,000 a year, get 7% returns, and in 30 years, you'll have over $1 million. Sounds amazing, right? Let me show you what they don't tell you about that $1 million. By the time you factor in inflation, fees, taxes, and panic selling during market crashes, your $1 million is more like $300,000 in today's money. And that's if everything goes mostly right. Here's the breakdown. At 3% inflation over 30 years, your million only buys what $412,000 buys today. Add management fees, and you're down to around $800,000. Factor in taxes and the inevitable panic selling during crashes, and you're looking at real purchasing power closer to $300,000. Here's the brutal truth. Compound interest works, but it's not the magic wealth-building machine they pretend it is. The second lie is that you need to be an expert to invest. Investing is complicated. Leave it to the professionals. This lie keeps you poor while making financial advisors rich. Here's the truth. You don't need to be an expert in everything. You just need to be an expert in one small area. Warren Buffett's business partner Charlie Munger put it perfectly. Buffett has an edge because he knows what he knows, and he knows what he doesn't know, and he sticks to what he knows. You already have expertise in something. You know your industry, your hobbies, the products you use every day. That's your starting point. Love coffee? You probably understand Starbucks better than some Wall Street analyst who's never worked in retail. Use an iPhone. You have insights into Apple that someone who's never owned their products doesn't have. The strategy is simple. Go an inch wide and a mile deep. Pick one industry you understand and learn everything about the major companies in that space. I know people who've made fortunes investing in only restaurant stocks because they worked in food service. Others focus on tech because that's their background. Some of the best investors I know only own 5 to 10 companies total. The experts running mutual funds, they're trying to be experts in everything, which means they're experts in nothing. Plus, they have to justify their fees by constantly trading and picking new stocks. You can just buy great companies and hold them. The third lie is that you can't beat professional money managers. This one drives me crazy because it's the exact opposite of reality. Professional money managers fail to beat the market 80 to 90% of the time. We covered this in detail in another video, but the data is overwhelming. Most pros lose to a simple index fund. Here's what's even crazier. Small investors like you have massive advantages over the professionals. Size is your superpower. When a mutual fund wants to buy a stock, they need to buy millions of shares without moving the price. When they want to sell, it takes weeks to exit without crashing the stock. You can buy 100 shares in seconds. You can sell your entire position in minutes. This creates incredible opportunities. When big funds panic and dump stocks, they drive prices way below what companies are actually worth. You can swoop in and buy great companies at fire sale prices. Warren Buffett said it himself. If anybody tells you that size doesn't matter in investing, they're trying to sell you a mutual fund. The act of big investors selling is what drives prices down, creating panic among other big investors. It's a cascading effect that creates massive opportunities for small investors who can stay calm. Professional managers are stuck in this system. You're free to take advantage of it. The fourth lie is that diversification protects you from risk. Don't put all your eggs in one basket. Diversify across hundreds of stocks to reduce risk. This sounds logical, but it's actually terrible advice that keeps you poor. Warren Buffett calls this over-diversification and says, diversification is for the ignorant. Here's why diversification is a wealth killer. When you own everything, you guarantee average returns. And average returns, after fees and taxes, are mediocre returns. Buffett's $160 billion portfolio is concentrated in about 10 stocks. About 80% of his wealth comes from just 5 companies. The most successful hedge fund managers own 10 to 15 stocks maximum. Real risk doesn't come from owning too few stocks. Real risk comes from not knowing what your companies are actually worth. If you understand a business and buy it when it's trading for less than it's worth, you're buying dollar bills for 50 cents. Why would you diversify that away? The investment industry loves diversification because it means you'll never get rich enough to stop paying them fees. They want you to own 500 mediocre companies instead of 5 great ones. Focus beats diversification every time. Find great businesses that you understand, buy them when they're on sale, and ignore everything else. The 5th lie is that timing the market doesn't matter. Just invest consistently and don't worry about timing. Time in the market beats timing the market. This sounds wise, but it ignores a critical reality called sequence of return risk. When you get your returns matters just as much as what returns you get. Let's say over 30 years, you'll get 2 years where the market returns 30%. Would you rather get those years at the beginning or the end? You want them at the end. If you have $800,000 saved and then get a 30% return year, you just made $240,000 in 12 months. That could cut years off your timeline. But what about 2 years with minus 30% returns? You definitely want those early. If you lose 30% when you only have $50,000 saved, you lose $15,000. If you lose 30% when you have $800,000, you lose $240,000. That $240,000 loss represents 15 plus years of saving $15,000 annually. One bad year at the wrong time can wipe out decades of progress. The brutal truth: there's a huge luck component to investing success. People who got unlucky with timing during major crashes saw their retirement plans destroyed. People who got lucky with timing built massive wealth. You can't control when crashes happen, but you can position yourself to take advantage of them instead of being destroyed by them. So what actually works? Now that we've destroyed these myths, here's what actually builds wealth. Understand that compound interest is helpful but not magical. Don't expect miracles. Expect steady progress with realistic expectations about inflation and fees. Become an expert in one area you already understand. Stop trying to be a genius about everything and get really smart about a few companies. Take advantage of your size. When professionals panic and crash stock prices, that's your opportunity to buy great companies cheap. Focus your investments. Own 5 to 10 companies you understand deeply rather than 500 companies you know nothing about. Understand that timing matters even if you can't control it. Be prepared for bad years and positioned to take advantage of market crashes. Here's what actually matters. They've been lying to you for decades, and now you know the truth. What do you do with it next? That's where wealth actually begins. The investment industry wants you to believe these lies because confused, scared investors pay more fees and make more trades. Simple, focused investing doesn't generate fees, so they don't promote it. Stop believing that investing is too complicated for you. Stop thinking you need professionals to manage your money. Stop diversifying your returns into mediocrity. The people getting rich from investing aren't following the conventional wisdom. They're doing the opposite of what the industry tells you to do. You don't need to be Warren Buffett to build wealth. You just need to stop believing the lies that are designed to keep you poor. Your future self will thank you for choosing the path that actually works.